Turning $1,000 into $10,000 sounds like a trick, like something is missing. Most people believe this requires a secret, a lucky stock pick, a complex trading strategy, or high-risk moves. The truth is far simpler, and frankly, more boring. This kind of financial growth is achievable for anyone who follows a steady, disciplined plan over a long period. They want you to believe that wealth is made overnight. But the fast path is often a mirage, leading to speculation and significant losses. The path to $10,000 is not a sprint. It is a long, steady walk. You don't need to be a Wall Street expert or spend your days staring at stock charts. The strategy that works is grounded in simple math, consistent habits, and the incredible power of time. The journey from $1,000 to $10,000 is a lesson in patience, proving that small, consistent actions can lead to very large results. Think of your initial investment as a seed. The real growth comes from your additional savings and the returns your money earns over the years. Turning a small sum into a much larger one often feels out of reach because we're conditioned to think in linear terms. The concept of that money working for you, earning its own money, feels abstract. Many have only felt the negative force of compounding through credit card debt, not the quiet power of it working in their favor. The financial industry often makes investing seem complex with jargon, creating a barrier that makes people feel they need an expensive advisor just to get started. The belief that investing must be complicated keeps people on the sidelines. We're bombarded with stories of fortunes made on cryptocurrencies or meme stocks. Those stories make investing look like a lottery, win big or lose everything. The slow, reliable path gets no media coverage. Finally, many people simply don't do the math. They see the gap between $1,000 and $10,000 and it looks unbridgeable. They don't calculate. Without a clear step-by-step picture, a financial goal can feel like an intimidating dream. A concrete plan makes it a tangible objective. Compounding is the engine that drives your growth. It's a simple concept. Your money earns a return, and then your earnings start earning their own returns. It's a snowball effect. At first, the growth is barely noticeable, but over time it picks up momentum. This is why time is the most important ingredient in your investment plan. The longer your money has to compound, the more powerful the effect becomes. Let's walk through the numbers. Imagine you start with $1,000 and save an additional $100 every month. We'll assume your investments earn an average return of 7% per year, a reasonable, historically based average for the stock market. Now, let's fast forward. After 5 years, you've invested your initial $1,000 plus $6,000 in contributions. Let's fast forward to 10 years. The growth is now much more noticeable. This is where the snowball of compounding really starts to pick up speed. By now, you've contributed a total of $13,000. With that same 7% average annual return, your account would be worth approximately $18,000. You contributed $13,000, and the market gave you an additional $5,000, helping you exceed your $10,000 goal. But the absolute first step in any investment plan has nothing to do with the stock market. Before you invest a single dollar, you need a stable base, an emergency fund. That's 3 to 6 months of essential living expenses set aside in a high-yield savings account. This buffer protects you from selling investments at the worst possible time. With your emergency fund in place, build the habit of consistent saving. Monthly additions are what truly fuel the compounding engine. Decide on a realistic amount, then make it automatic. Set up an automatic transfer for the day after you get paid. This way, the money is invested before you have a chance to spend it. This discipline is the most fundamental skill of wealth building. Look at your budget and find places to cut back, like eating out less or canceling unused subscriptions. Every dollar you free up is another soldier for your investment army. Think of this as laying a house's foundation. Without a strong base, the entire structure is at risk. Your emergency fund and automated savings are that foundation. Rushing this step is a common and costly mistake. With your savings automated, it's time to invest. The goal isn't to pick winning stocks, but to own a piece of the entire market. You can do this with a low-cost broad market index fund or ETF. These funds hold hundreds of companies, providing instant diversification. Why is diversification so important? Diversifying with index funds protects you from a single company's failure. Instead of betting on one stock, you're betting on the long-term success of the entire economy, which has historically been a reliable bet. The second key is to keep costs low, as fees are a silent killer of returns. A 1% annual fee might sound small, but over decades it will consume a massive portion of your gains. Look for index funds with expense ratios of 0.1% or less. Many providers offer funds with fees close to zero. The action step for this phase is simple. Open a brokerage account, set up automatic transfers from your bank, and have that cash automatically purchase shares of a single, low-cost, broad market index fund. A single, well-diversified fund is all you need when starting out. This strategy is boring, but it's effective and lets you get on with your life while your money works quietly in the background. Once your money is invested, the hardest part begins: waiting. The market will go up and down, and there will be times your account balance falls. This is normal, the price of admission for long-term returns. Your job is to do nothing. Do not panic and sell, as selling in a downturn locks in permanent losses. As you add assets like bonds to manage risk, you'll need to rebalance. Let's say your portfolio drifts from its target allocation after a good year for stocks. Rebalancing means selling some of the asset that has done well and buying what has done poorly to get back to your target. This forces you to systematically sell high and buy low, a disciplined, unemotional way to manage risk. Once a year, check your portfolio. If it has strayed significantly from your target, make the necessary adjustments. This simple annual check-in is all the maintenance your plan requires. It keeps you engaged without encouraging you to tinker constantly. The most important part is cultivating a long-term mindset. You are investing for a goal that is a decade away. Think of yourself as a gardener, not a day trader. You plant the seeds. You water them with new savings, pull the occasional weed by rebalancing, and let time do the heavy lifting. Patience is a necessity. Many people start with good intentions but fail because of impatience. After a year or two, they see their balance hasn't grown dramatically and get discouraged. They abandon the steady strategy in search of a shortcut. The desire for a quick win is the greatest enemy of a successful long-term plan. Another major trap is fear. The stock market doesn't go up in a straight line. There will be corrections and bear markets. Your instinct will be to sell, but this is a mistake. By selling, you turn a temporary paper loss into a permanent real loss. The people who succeed are the ones who stay invested and even continue buying during downturns. High fees are another silent portfolio killer. Over the long term, most expensive funds fail to perform better than a simple low-cost index fund. A difference of 1% can cost you tens of thousands over a lifetime. Keep it simple and stick to low-cost index funds. Many investors overcomplicate things, second-guessing their strategy and frequently buying and selling, often at the wrong times. A simple plan that you can stick with is far superior to a complex one you abandon. For most of your journey, a single total stock market index fund is all you need. This is not a get-rich-quick scheme. It is a get-rich-slowly plan. It's built on sound financial habits, not risky bets. The path requires three things: save money every month, invest in low-cost, diversified funds, and be patient for a very long time. The power is its simplicity and compound growth. Acknowledge the risks. Returns aren't guaranteed and life can get in the way. You can't control the market, but you can control your savings rate, the fees you pay, and your behavior in downturns. Focus on what you can control. Let the market do the rest. Start today. Open the account, set up an automatic transfer, and make your first investment. $10,000 starts with your first $100. Commit to repeat it next month and the month after. This boring strategy builds real, lasting wealth. It is simple. It works. For educational purposes only, not financial advice.